Indirect tax is defined as the tax imposed by the government on a taxpayer for goods and services rendered. Unlike the direct taxes, indirect tax is not levied on the income, revenue, or the profit of the taxpayer. It can be passed on from one individual to another. So let's know the terms related to indirect taxes. What are hidden taxes? Hidden taxes are the tax indirectly assessed on the consumer goods without the explicit knowledge of the consumer who is purchasing that product. At the heart of the concept of hidden tax is a notion that if you cannot see it, your purchasing behavior will remain unchanged. With the advent of modern transactional system, visibility into a variety of hidden taxes ranging from the highway tolls paid, which uses the automatic transponder to music downloads, is becoming more obscured. Hidden taxes are everywhere, lurking mostly unseen, while effectively raising the prices of the ordinary goods that we consume in our daily lives. Everyone is aware that a sales tax applies when they purchase a good in any state, but not many are fully aware of the extent to which the hidden taxes are included in the final price. Taxes on cigarettes, alcohol, gambling, gasoline, and hotel rooms. These taxes are typically conflicted as a part of an ordinary transaction, which serves to bury them in a final price, a price which is very high than it would be without the hidden tax. Other example includes the duties imposed upon the products which are imported from the overseas. Tariffs are a new cost that the manufacturer has no choice but to pay if they want to continue shipping their goods. Given the interconnection of our modern global economy, the most suppliers they cannot afford to lose the international market share. So they bury the increased new cost into the product cost, hoping the demand is not affected. These increases pass along through the wholesaler and the distributor who have their own margin requirements making their way to the final consumer. So let's understand this with an example. Suppose I am a factory owner and I produce pens. So I need pen, I need ink, color, plastic, machinery, all these raw materials. So this eventually will increase the cost of my good or the cost of the production, because as I'm buying these products, I also have to pay taxes individually. If I didn't have to pay taxes, then my cost of production would be less and so would be the price of my product. So the ultimate product price, the manufacturing is adding the price of the tax which is paid by him, and that's an expense for the customer. Suppose the price of the plastic is 10 rupees and the tax is 5 rupees, then ink price is 10 rupees and the tax is 2 rupees. Then the total cost of production is 10 plus 5 plus 2, that's 27. But when the manufacturer charges the customer, he charges 27 plus his profit margin. But if the taxes were not there, the customer would have been charged 20 rupees plus the margin of the producer. The customer isn't aware, but he is paying for all the taxes that the manufacturer is paying. So the service tax, these are the indirect taxes which the taxpayer paid on the various paid services. These paid services includes the telephone, tour operator, architect, interior decorator, advertising, health center, banking and financial services,